Today, we're breaking down Dialog Axiata. We're going to look at how they managed to engineer a massive surge in profit, figure out where all that money went, and uncover the pretty critical risk this whole strategy created.
So let's get right to it. Dialog Axiata's net profit exploded by 162%. The big question for us is, how does a mature telecom company even achieve that kind of insane growth? This is fundamental analysis for educational purposes, not financial advice.
Now, the source of this profit, it's not what you'd probably expect. It wasn't driven by some huge increase in sales. Actually, their revenue growth was pretty modest.
Here's the real story. While revenue crept up just over 6%, their direct costs absolutely collapsed by more than 15%. So this wasn't about selling more. It was a story of incredibly disciplined cost management. This is a classic textbook example of operating leverage in action.
And the impact on profitability was just massive. The company's gross margin leaped from around 40% to over 52%. Now, this isn't some minor tweak. We're talking about a fundamental structural shift in the company's core profitability.
So, profits are soaring. The next logical question is, what did they do with all that money? For that answer, we've got to turn to the balance sheet.
Okay, so at the beginning of the period we're looking at, the company was carrying total borrowings of 177.7 billion rupees.
9 months later, that number dropped, and dropped significantly, all the way down to 76.9 billion.
So here's the punchline. They used their incredible earnings power to aggressively pay down nearly 31 billion rupees in debt. This is a major move to strengthen the company's financial health for the long term.
But a move that aggressive wasn't free. It came at a price, and that price was introducing a new and pretty significant risk to the business.
And you can see that risk captured in this one metric, a current ratio of 0.43. For any analyst, a number this low is an immediate red flag that you have to investigate.
So what is the current ratio? It's basically a measure of a company's ability to cover its short-term bills with its short-term assets. A ratio below 1 is a warning, and one as low as 0.43, well, that signals a very tight liquidity position. It suggests they might actually have a hard time meeting their obligations that are due within the next year.
So how can a company be so profitable and yet face a liquidity risk like this? The cash flow statement is the key. It's what unlocks this whole puzzle and really ties the entire story together.
Get this, the company's cash conversion ratio is at an elite 3.4 times. This metric tells you that its ability to generate actual cash is way stronger than its income statement alone would lead you to believe.
To put that really plainly, for every 1 rupee of net profit they reported on paper, the business actually generated 3.4 rupees in cold hard cash. This huge gap is mostly because of non-cash charges like depreciation. This business is a true cash cow.
So let's follow the money. The company generated over 50 billion in cash just from its operations. After they put about 16 billion back into the business, they used the rest to repay that 31 billion in debt and pay out another 17 billion in dividends. This was a strategic choice, and it's exactly why the cash balance fell and why that liquidity ratio got so tight.
This whole case study gives us 3 really critical lessons that you can apply when you're analyzing almost any company.
First up, cash is king, but debt is the killer. In a world with high interest rates, Dialog made a strategic choice. They decided to prioritize paying down expensive debt instead of just hoarding a big pile of cash. This makes the balance sheet stronger in the long run, but it absolutely increases their vulnerability in the short term.
Lesson 2, margin expansion can be way more powerful than revenue growth. A 6% revenue increase is solid, don't get me wrong, but that 12 percentage point jump in gross margin is what truly transformed the company's earnings. It just proves that disciplined cost control can have a much more profound impact on the bottom line than just sales growth alone.
And finally, always watch the current ratio. An impressive return on equity of over 24%, that can easily mask some underlying issues. That low current ratio of 0.43 is the critical warning sign that profitability isn't the whole story. Liquidity is just as important.
Which leaves us with a final question. Was Dialog's strategy a masterclass in aggressive balance sheet repair, positioning it for future success? Or is it a dangerous high-wire act, leaving the company way too exposed to a sudden shock?